world and the markets are going a little crazy right now. And we want to address this, what we're seeing in the market, but not from the perspective of whether or not we agree with the work of the current administration, but we want to talk through what we're seeing today from a historical perspective. What do we know and what can we learn from history, and what is different about what we're seeing today in the market? So here's my disclaimer as we dive into this topic. We know that politics strike a unique chord with everyone, but the purpose of our discussion today is not to take sides or to state a political opinion, but just to talk about what we're seeing in the market, what we know historically, and ultimately to arrive at something that offers some reassurance, some confidence in the investors who are listening, and hopefully soothes some of your concerns. So we've got a lot that we get to talk about today. We're so grateful to have the experience that we have here on the phone call. And so we want to talk about some historical administrations and what we've seen in terms of their economic impact. So where should we start?
Yeah. Well, I think before we even jump into the history, which we got two of them lined up, but I think the idea that like politics, people are looking ahead. They're not looking at what is, they're looking at what they expect. And, there's a new policy, Trump will announce something or he'll change something that was already announced. And, people are trying to adapt, they're trying to adjust. And all that is future expectation that they're trading on, that they're making adjustments based on. But what we want to talk about today is not the political, what are we expecting, but really what is, and going back to a couple of prior administrations to say, what did it feel like? What were people thinking about, and then what actually happened in the economy. So, Randy, I think you're the expert on some of these today because you've lived through some of these.
I think one of the things that I enjoy is history, and I go back, particularly from an economic standpoint. So, in my time frame, I was actively in business during the Carter-Reagan transition. In fact, even going back to, I was still in college when Nixon was the president, and Watergate and all the chaos that came. Prior to that, of course, we had the Lyndon Johnson with the war on poverty and raising the money to pay for the Vietnam War. All these things were major impacts upon our economy. So again, going back, I like the fact that when Reagan came into office and Carter was finishing up his term, our energy, we were completely dependent upon importing our energy, fossil fuels, oil, gas. We were short. We had put so many controls and regulations on the energy, complex that we weren't producing enough. And Reagan came in and said, this is garbage. Release it. And so what happened is from that period of time forward through the 80s and the 90s, oil companies had the ability to explore and use technologies in order to get more. And so right now, the position that we have, which is different than what it was in 1980, is that we are energy independent. In fact, we are selling energy, liquefied natural gas and oil and other things. We are actually selling those to other countries, which 20, 30 years ago seemed almost impossible to get your head around. So again, I think there's a dramatic shift on what the underlying, because most of us, we get in a car, we flip the switch on, our electricity comes on, our air conditioning comes on in the summertime, our heater comes on in the wintertime. There was a point in time where Jimmy Carter was walking through the White House and he was wearing a sweater, turning down the thermostat in the wintertime and saying, everybody in America needs to be suffering a little bit. And it was just interesting, the backlash, because we had all the energy. It's just that it wasn't being, the regulations stopped it from being produced. So,
yeah. Well, and that Carter-Reagan, we kind of want to talk about that moment. You mentioned before, but what were some of the other items of, we talked about interest rates.
Interest rates were through the ceiling. Right. I bought a car. It was the company car that I was using, and the owner of the company says, "Would you like to buy your car?" Because I was starting my own company, and I said, "Yeah, I'd like to buy that." I went to the bank, a used car loan, and the guy was really happy. He said, "This is really a good rate." It was 25%.
Oh, my word. What year are we talking?
We're talking about 1979. 25%.
25%. That's a good rate.
And the
Steal of the deal.
Yeah. And the banker says, this is actually a pretty good rate. And I went, looking back at it now, I should have choked and thrown up on his desk. It was unbelievable, but those were interest rates for mortgages were 14, 15%. Yeah. So again, there was this just massive cost to do business if you didn't have the cash. And so people were putting money in certificates of deposit at banks. They were advertising CDs at well over 12%.
Wow.
Right? And so you had this big, massive flux as far as what did it cost to do business. Yeah. So again,
and then unemployment in that season. So interest rates are really high, borrowing rates are really high. Unemployment was also high, right?
It was because you had post-Vietnam War. So you had all these soldiers and all these people that were being put back into
the workforce.
Into the workforce. They were not, we sent 300,000 troops just to Vietnam, for crying out loud. So all those people were coming back into the workforce. So unemployment shot up, inflation shot up because there's high demand for products and services. So, but during at the end of 70s, in the 79 to 80, unemployment shot up well over 10%. Wow. And you could feel it. You could feel that people just didn't have money. They were desperate. And so again, different times, different circumstances.
Yeah, but I think it's a great moment just to kind of put ourselves in that moment to say, none of people have work, right? They're struggling to get jobs. Anyone who does have some jobs, they can't really borrow because borrowing is so expensive. They're coming with all the Vietnam, blowback. I mean, Vietnam's ended, but all that stuff coming back in the early 80s of the social unrest, the uncertainty. Our country's just gone through those, and to be in that moment, then you have a new president walk in, right? Reagan is now in office. Volcker comes with him as the chairman of the Fed, and man, just really, I would say, kicks the economy in the teeth, of saying, hey, we're gonna bring down inflation, we're gonna make some major changes. And I think politically, we're talking about the politics here. Politically, man, there had to be feelings of chaos, uncertainty. We're never going to get out of this. Like that had to feel a different way. But then we look back today, we look back in the early 80s and say, hey, what was the economy doing? What was the outcome years later? Those who lived through it, have those scars and memories. But looking back, we pulled up some statistics, but during Reagan's first term, the S&P 500 grew 30%, over those years. And then for his second term, it grew 67%.
Which was phenomenal.
Phenomenal growth. In the early to mid 80s, you have phenomenal growth. And so people who were fearful of investing and said, I don't know what's going to happen to the economy, all this political rhetoric, get me out of here. Or said, I'm going to put it all on some certain stock and just bet the farm on this one thing. Man, they may have really struggled. But someone who said, I'm going to take a well-diversified approach. I believe in the U.S. economy. I believe in the future of our country, and we're going to get through this. They were handsomely rewarded, for staying invested during those 80s.
But it's gut-wrenching when you see your portfolio drop 20, 30, 40%.
Sure.
And you try to talk yourself out of the anxiety that you're going through. You're saying, okay, I'm in for the long run. Well, you're hoping that you get to the long run because it is gut wrenching.
Yeah,
but
and if you're in a season of life where you're on the cusp of retirement, or you need that cash, or you're growing your business, right? There's moments where it feels even more painful.
Yeah, and again, we have options to temper the client's portfolio, so we're not taking all the volatility, and we can do that obviously with using certain instruments to accomplish that, right? But at the same point in time, volatility is going to be here. It's a natural process. So again, I think the biggest risk that a lot of people took over the last 2 or 3 years is they concentrated their investment portfolios in just a handful of stocks. And they thought, okay, these are my winners. I'm just going to keep pushing them and keep pushing them. Well, again, you're gambling now. Yeah. You've gone from investing to gambling, and you've concentrated all your holdings or the vast majority of your investment into just a very few number of stocks. And during 22, 23, 24, you did pretty well. But all of a sudden, the piper has to be paid. Yeah. And these stocks can't go up forever. And there's going to be a rebalancing of accounts. So anyway.
But I think what is so interesting in that moment, some people bought those stocks, NVIDIA, Facebook, Apple, some of these high flyers, they bought those on purpose, right? They purposely purchased them, overweighted their portfolios because they said they're doing so well. I think others had no idea. They're in an ETF that they're not actively watching. And because those Magnificent Seven became such a large piece of our indexes, they became, perhaps unintentionally, such a large piece of so many people's portfolios. It would not be uncommon at the end of 2024 for someone to have Apple or Facebook that was 5 or more % of their portfolio, which doesn't sound like a huge amount, but if you have 5 or 6 of those companies making up 20, maybe 25% of your whole portfolio, and they have a bad week, you see meaningful differences in your portfolio.
Well, the S&P 500, which is 500 stocks, right, of the largest publicly held companies that trade in the New York Stock Exchange, 30% of the concentration was in those 7 stocks. So 30% were controlled by 7 stocks. And so there's a lot of discussion at the end of 24. It's like we got to rebalance this. We got to take away that dominant percentage that these companies have within the S&P. So
and that feels painful, but in a different way, right? Yeah. So for many investors, it's like, why would I let go? Look at what it's produced over the last year or 2 years, right?
Right.
Yeah. That's great. Well, I think to rewind the clock again a little bit further, we just talked about the Reagan administration, what that felt like. Let's go all the way back to Hoover.
Hoover.
He's been in the news
just before I was born.
Just.
I mean, a little more than just, but yeah.
Little more. Yeah, exactly.
So Hoover was the end of the 20s, early 30s. And go ahead, Randy.
Again, Hoover.
Great Depression.
Hoover was on the Roaring 20s. And the Roaring 20s led up to his election. And then the market, there was the same conversation about tariffs. And there's 2 congressmen that passed. It was Smoot-Hartley, I think is the names of the congressmen. And they created these tariffs. Now, again, the tariffs said we want people that are doing business with America. We want to be having we want to put tariffs on them so we get some piece of the profit coming in. The seller has to give up some share of the profit. Now, again, the stage in the world was completely different. The stage in the world that Japan, they were starting to rise as a power at that point in time in history. Germany was rising as a power in that time of history. It was post 1918, which is the end of World War I. There was a lot of political unrest, particularly in Europe. And then you had what was going on in Japan. China was not even a blip, so to speak. I mean, Japan was the economy. But going into the 1929, when the market went down dramatically, this is what I point out to people, is that banks could take the depositors' money and invest it in the stock market. And a lot of banks didn't just invest a dollar for dollar. What they would do is go to another bank and borrow 10 to 1. So they were purchasing stocks and equities because that market was going up. Well, it was going up because everybody was buying. So it's an automatic reaction to not enough stocks and too much money and everything. And you go back and look at the earnings, the price, the PE ratio, which we use as an indicator of
price
value.
To earnings ratio. Yeah,
it was like way off the charts on these companies. And the people that were understanding how this really works were saying, no, we're going to hold this back. And again, what happened is that is not a part of our economy right now. That is not even close. Banks cannot do that. They can facilitate trading, but they can't take your deposits and put them in the stock market. They can't do that.
Or leverage them in the same way, like the 10 to 1 sort of scenario, right?
Exactly.
So we have that going on. We have these tariffs coming on, which, people in the news, talking heads will relate back and say, hey, we're doing tariffs now. Hoover loved tariffs. But, we're talking about the Great Depression. We're talking about some major, difficulties that people are struggling through. Probably some of the biggest economic struggles.
25% unemployment was in the Depression.
Unreal.
So everybody was affected by it.
Yeah.
And there's no question about it.
So the uncertainty, the difficulty, the struggle, politically what's going on, economically what's going on. Then we walk into FDR. He comes in, all sorts of what I would say, current people would say, well, he's a Democrat. He is not going to be good for the economy. He's not going to be good for these things. But he had the New Deal, brought in Social Security. Just looking at some of the indexes, the Dow Jones Industrial Average under FDR's first term, I will make you guys guess, but it's 245% is what it went up.
Oh my goodness.
And part of that was so far down, right? It's part of it.
They lost the stocks lost like 90% of their value.
Yeah.
In some cases.
So then that recovery, brings it back up. But in looking at, politically what had been happening with Hoover, then politically what was going on with FDR, man, there were so many different thoughts and opinions of what could be happening. However, the U.S. economy, it suffered. Man, did it suffer, but then turned and continued and grew and grew and grew and grew into the next, you think about the 50s and the 60s and some of the great economies we had there. So it's part of what I think we want to talk about today, and it's been a good kind of history lesson. It was just saying, there are similarities to some of these older eras. There are similarities, but there are also massive differences. And
Right.
Randy, your
Right.
comment about the energy, I think is such a good one. There's probably 20 more that we can say, hey, the world powers are different. You talk about Germany and Japan rising up, in their economic sense under Hoover. That was some real concerns that, are these economic powers going to overshadow and dwarf what we're doing? And, we all know how the world, took different turns from there. But even currently, we talk about China and say, is China going to dwarf the U.S.? I think when the EU came about, is the EU trading bloc, is that going to be so meaningful? So we have all these political question marks. But I think what we want to look at today is over time, the economy in the U.S. has done so well in the long run.
And it's cyclical. I mean, I that's what we're getting to by looking back in history. And I love this quote when we were preparing for this podcast by Siegel. He wrote an investment classic book called Stocks for the Long Run. And in it, he says, bull markets and bear markets come and go. It's more to do with business cycles than presidents.
Yep.
It's not to say that new administrations don't have an impact on the economy, but we have to look at it from this cyclical perspective. What do we know of our past that might, repeat itself?
Well, again, I think one of the things I say in the office all the time, the debt is the key. And let's go back to a more recent history event. So let's go back to 2008. 2008 was the housing bust.
Yep.
And what happened is that banks, again, going back to banks, they were allowing mortgages to be created on homes that the valuation was completely crazy. And so their standard for lending was different than what I would consider to be a good loan. And so people that had no income, they had no way to support what they were buying on the mortgage, they were leveraging into the next home. So you had, in fact, in Las Vegas in 2007 or leading up to 2008, there was an entire development. And they went through and analyzed it. Not a single resident lived in it. The thing was vacant. What they were doing is buying and selling these homes, and they're selling to the next sucker. So you look at it's the musical chairs, right? Who's going to finally not get a chair? And when it collapsed overnight because people stopped buying, because they were selling what was supposed to be A quality paper. In other words, a good borrower, good collateral, good down payment. They were tying them all up in these bundles, and they're selling to Washington or to Wall Street. And at some point in time, Wall Street woke up and said, oh, maybe we ought to take a look and see what the risk level is in these things.
Right.
And as soon as that happened, it stopped. And Wall Street stopped buying it. The market collapsed. We had this backlash. Again, it took us a while to get out of it. And those people that had borrowed way more than they should have, some banks went down because they put themselves at too much risk. Washington Mutual is one that kind of stands out in my mind. But again, my attitude is you got punished because you deserve to get punished. Right?
Over leveraged. Yeah.
Yep.
Yeah. Well, the debt, and we see the debt, in individual people, in investments, in just the general economy. Our deficit and our debt, as a country, continues to grow. And there's been a lot going on in the bond markets, recently, and we've had a lot of office discussion of whether or not that is indicative of underlying currents, not just the political rhetoric, but underlying currents of what's happening in the economy. If it's people who were in unique trade positions, in essence, to capitalize on certain interest rates, and now we're having to unwind those positions. We have thoughts. We're not going to talk about that today as much, but I think a lot of that is we will see, as the economy moves forward, why there's been so much movement in the bond market when there usually isn't,
right?
And how the U.S. moves forward with tariffs and refinancing debt. All those play into our current market economy, and I think the risk here, and what we're the reason for this podcast even is, if you just listen to politics, right? It depends greatly on who you listen to, whether we're doomed or we're on the cusp of greatness, or what it may be. But either way, that's looking at the future expectations. And here, we're talking through some of this history, kind of reliving some of these moments of chaos and how the U.S. continued through them. And I think that's a good, hopefully a good stability, builder for folks as we look at the chaos we're in right now. There's uncertainty, there's volatility, there's unknowns, there's parts of our economy that look great, there's parts that really look concerning. And so rather than listening to the political rhetoric, but to lean on what do we know, what do we not know?
Right.
And a piece that I think was so interesting that we were talking about before is, right now, and Randy, I think you mentioned this, right now, the economic numbers have not changed meaningfully from when Biden was in office to now when Trump is in office. Like, we still have inflation, we still have unemployment. They're in process of moving. There's expectations of movement, but the economy takes time. And so from an economic numbers position, we may not be so different than we were, but the expectations are so different.
So if you could put blinders on and you didn't hear or listen to any of the media, the talking heads in my mind, what I call the bleeds it leads. So they always emphasize the negative. But if all you had to look at was the data, and the data is not that much different from Biden to Trump. You would think they're doing devastating things in the back rooms right now, but when you actually look at the data, it hasn't changed that dramatically. You would have thought that unemployment would have been rising. Unemployment has not risen that much. The employment numbers, the inflation has come down, but the cost of goods and commodities is starting to come in line. We're about 3%. They'd like to be at 2%, but it's not dramatically different. Not like what we experienced back in the 80s when all of a sudden the cost of everything went up 10, 20%. So here we're talking about 1% is the adjustment here. The GDP, they're talking about the GDP, the gross domestic product, what we produce as a nation, to drop from 3% down to 1%. Okay, that's a contraction. And if you have 2 quarters of contraction, technically we are a recession.
Right. Textbook definition. Yeah.
Right. But again, I think for people, I don't think jobs are as plentiful right now as what they were maybe like 2 years ago. But I don't sense unemployment numbers are dramatically bad. So again, if we look just at the data, things are not horrible.
I think this is a great point you're making because, we obviously took a look back at history, but one of the things that we want to regard right now is what's different. What's different right now that we're seeing than what we've seen before? And that's really something to take note of and collect that together with the historical information that we have and say, okay, what are some of these anomalies? What are some of these differences? Where are they coming from? That's a lot of the work that we do is taking a look at indicators. What information do we have so that we can make an informed decision? Oftentimes we settle back on the prominence of the U.S. economy, on the performance of U.S. businesses, on staying in the market for the long term, right? Diversification, broad diversification. These are some tenets of investment philosophy that have served investors over time. And that's both in history and we believe will continue into the future. So, well, hopefully our conversation today was uplifting, was positive, offered some perspective in the midst of a lot of news and media that can just draw panic, honestly, and be really frustrating because there's so much information, so many differing opinions. So we hope today it brought a little bit of reassurance to our listeners. So to all those out there, thank you so much for listening today.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.